If you are choosing a tokenization platform in 2026, three names keep coming up: Securitize, Tokeny, and Bitbond. Securitize says it is the largest tokenization platform and the only one above $4 billion in assets under management. Tokeny wrote the compliance standard the industry argues about. Bitbond will sell you a token contract tonight for $99, plus gas. In the next 7 minutes, what each one is, what they license, what they cost, and which one fits your asset. Because which is best is the wrong question. These three do not compete for the same buyer. Securitize is a licensed full-stack platform, an SEC-registered broker-dealer that also runs a regulated trading system, plus an SEC-registered transfer agent. Issue through Securitize, and you need no license of your own. Tokeny is compliance infrastructure software. It authored the token standard and sells issuance and compliance tooling. And it holds none of those three licenses. Where the law wants a regulated wrapper, the issuer brings one. Bitbond is bank tokenization tooling. Its own site pitches it to banks, asset managers, and corporate issuers as institutional-grade infrastructure. Token Tool deploys the token. Offering Manager runs the offering. Like Tokeny, it holds no license. So the fork that decides this is not which token standard. It is whether the platform holds the licenses, or you do. In July, Securitize listed on the New York Stock Exchange and tokenized its own stock on day one. Its second quarter report shows a record $4.3 billion of tokenized assets under management, transaction volume up 147%, and a chief executive citing roughly $5 billion on-chain now. The same report holds the other half. Revenue down 5% to $14.4 million. Assets under administration down about 20%. A net loss of $21.7 million. And its flagship, BlackRock's BITL, sat at $2.69 billion on August 21st, with a fund called USYC edging ahead of it in tokenized government securities per RWA.XYZ. Growth, losses, and a moving target. Tokeny sells what Securitize built for itself: compliance inside the token. It authored the T-Rex protocol, standardized as ERC-3643, now final on the Ethereum Standards Registry. Every wallet maps to a persistent on-chain identity, and the token rechecks it on every transfer. Since May 2025, it has been majority owned by Apex Group, a fund administrator reporting over $3 trillion under administration. Its flagship case study is ABN AMRO, tokenizing a green bond for the real estate company Vestida on Polygon. Tokeny publishes no deal size, so neither will we. And Tokeny publishes a price list. €3,000 a month for standard, €5,000 for advanced, minimum term 12 months. Call it €36,000 a year, committed, before you issue anything. Bitbond is the Berlin one, founded in 2013. In 2019, BaFin approved a securities prospectus for its BB1 bond, the first German security token offering to have one, issued on Stellar. Today, it sells tooling. Token Tool deploys across the 11 chains on its pricing page, no code, self-serve. Its docs describe the asset token as ERC-20 compatible, with compliance options from the ERC-1400 family. ERC-3643 appears nowhere in them. The prices, from its own pages. Token Tool is $99 for a core token, $199 for advanced, $299 for the asset token, plus gas. Offering Manager is free to test, or €299 a month billed annually. Its homepage carries bank logos with no case study behind any of them. Now the axes that actually decide this: licenses. Securitize holds all three: broker-dealer, transfer agent, trading system. Tokeny and Bitbond hold none, so you bring your own regulated wrapper. Cost. Here is the surprise. 2 of the 3 publish a real rate card, and the licensed full-stack platform is the one that does not. Securitize publishes no price. The only public floor is an outside estimate, $50,000 to $100,000. Tokeny starts at €36,000 a year, committed. Bitbond's cheapest token is $99, once. That spread is not a bargain, it is a measurement. A per-token fee and a platform engagement are not comparable products.
Standards. Securitize runs its own DS protocol, a superset of ERC-20, and uses neither standard the debate is about. Bitbond's asset token is ERC-20 based too, which leaves Tokeny's ERC-3643 as the real outlier, and its author drives the argument. Notice that the platform BlackRock uses picked neither. Chains and time. Securitize's platform spans 10 networks. Per rwa.xyz, Bitbond lists 11. Tokeny publishes none. Nobody publishes a service level with a number. Industry content says 4 to 12 weeks on an existing platform. Tokeny says a few weeks. Bitbond's self-serve implies same day for a bare token. Traction. Carefully. 4.3 billion is Securitize's tokenized assets under management in June. 32 billion is Tokeny's cumulative total since 2017. Not a balance sitting there. 1.2 billion plus is Bitbond's own live count. None is independently audited. One thing to watch. The traditional transfer agents want issuer-authorized tokens to be the only ones that qualify. The Securities Transfer Association filed that argument on July 1st, and Continental and Computershare backed it weeks later. Both are now Securitize partners. Nobody here has a special exemption. All three run existing securities law through different structures. So which one wins? It resolves by which shelf you are shopping. An institutional fund at scale, where you want the licenses to be the platform's problem instead of yours, Securitize. That is the shelf BlackRock, Apollo, KKR, and Hamilton Lane are already on. Compliance enforced inside the token, on a standard whose association counted 92 members in December 2024, including DTCC Digital Assets, Invesco, and ABN AMRO. Tokeny. Tooling instead of a platform. A bank that wants to issue in-house, or a first ticket small enough that a $99 contract is the right size of commitment. Bitbond. And keep it in proportion. Every tokenized real-world asset distributed on public chains, all platforms combined, came to $38.4 billion on August 21st. Securitize is $5 billion of that. Real market, still a small one. 3 shelves, 1 question. The answer is whichever shelf your asset actually belongs on. Subscribe if you want the letters, not the press release.